Hey everyone, and welcome back to the Finance Zone. As we all know, investors play a major role in the economy. Venture impacts the pace of monetary development since it is part of a total interest and, more critically, impacts the gainful limit of the economy. Let's talk about the administrator and CEO of Berkshire Hathaway, Warren Edward Buffett. He is an American investor, business big shot, and humanitarian. He is viewed as one of the best financial specialists on the planet and has total assets of $88.9 billion as of December 2019, making him the fourth wealthiest individual on the planet. Some people have to try for ages to crack Warren's golden principle of investing in the right stocks at the right time, but there is no shortcut to success. So it is not just a formula, but his lifetime of experience, which we will share with you today. Today, we're going to be talking about Warren Buffett's 7 principles of investing. Make sure you stay until number 7, as you don't want to miss these golden rules of investing, which will help you to be successful in this field of stock exchange. Number 1, do not follow the crowd. Ignore the market, the crowd, and its fashions. Warren Buffett's passion is bridge. He once said, "I wouldn't mind going to jail if I had 3 cellmates who played bridge." Noting the similarity between bridge and investing, he stated the approach and strategies are very similar. In the stock market, you do not base your decisions on what the market is doing, but on what you think is rational. With bridge, you have to stick to a taught offering framework. While there is no best framework, there is one that works best for you. When you pick a framework, you have to stay with it. Essentially, with contributing, to be fruitful you should have a framework, an arrangement that decides your advantage designation dependent on your one-of-a-kind capacity, ability, and necessities to face the challenge. Similarly, as there is nobody's best offering framework, there is nobody's best resource allotment. In any case, there is one that is directly for you. When you create your plan and put it in writing, you need to stick with it. Here is Buffett's advice on the subject. Once you have ordinary intelligence, what you need is a temperament to control the urges that get other people into trouble in investing. As indicated by Warren Buffett, the indulgence in life is doing what you prefer. By following this counsel, it appears to be conceivable that everybody can bear the cost of an extravagance or two. Buffett has said on many occasions that he adores what he accomplishes for work, so he doesn't invest a lot of cash or energy in movement or unwinding. He makes the most of his everyday life and in this manner lives in the lap of extravagance. You don't have to have billions to do what you love. Additionally, you probably would not continue with an exceptionally fulfilling life if you do not do what you love. Whether or not you are not as in warmth with your movement as Buffett is with his, find a recreation action that you do venerate. If it's possible, you can even endeavour to pick up a side compensation while doing it. Number 2, invest by facts, not emotions. One of the keys to Buffett's prosperity as a financial specialist is that he keeps away from the inclination to take part in what Thomas Sowell called stage 1 thinking, a shortcoming of most speculators. They see the emergency and the dangers but can't see past that. Their stomachs assume control, they can't control their feelings, alarm sets in, and very much created plans are surrendered. Buffett takes part in stage 2 thinking. He expects that an emergency will lead governments and national brokers to concoct answers to address the issue. What is more, the more prominent the emergency, the more prominent the reaction is probably going to be. That permits him to see past the emergency, empowering his head to keep command over his stomach and feelings. Whenever you end up responding to an emergency, ask yourself, am I engaging in stage 1 thinking? Do I know something the market does not? Is the news already incorporated into prices? Do I want to sell when valuations are low and expected returns are high? Will governments and central banks do nothing, or will they address the problem? Have I reacted in the past to such events? How did that turn out? Most important, you need to ask this question. If I sell now, how will I know when it is safe to buy again? This is a big problem for those who sell during a crisis. It is unreasonably simple to settle on fast choices without thoroughly considering things. Notwithstanding, it is difficult to endure the results of such ill-advised choices. As indicated by Warren Buffett, you ought to be able to explain why you're taking the job you're taking, why you're making the investment you're making, or whatever it may be. And if it can't stand applying pencil to paper, you'd better think it through some more, and if you can't write an intelligent answer to those questions, don't do it. Whereas sparing shrewdly and living parsimoniously has prompted Buffett's extraordinary riches, his pledge to thoroughly consider choices has likewise been fundamental to his prosperity. Number 3. Buy wonderful businesses, not cigar butts. Although Buffett could utilise his billions to go overboard on extravagant houses, costly vehicles and different extravagances, he doesn't. He rehearses cheap living and abstains from going through cash absurdly. The draw to go through cash, regardless of whether we amass it after some time or come into it out of nowhere, can be extraordinary. Yet following some guidelines from Buffett's experience can, without much of a stretch, lead to more prominent riches, budgetary autonomy, and a less upsetting obligation-free life. Do not place your eggs in numerous bushels. Set up your assets in one place and continue to watch that one. It is not necessarily the case that you are not coerced accepting the things that satisfy you on the off chance that you have the cash to do as such. In any case, you ought to consistently consider things and quest for bargains. Try not to go insane because you have the cash to spend. Number 4. Only buy stocks that you understand. The idea of canny pudding is that by purchasing partakes in an organisation, you should act like the proprietor of the business, not the proprietor of a bit of paper. That implies you have to comprehend the organisation's working basics. Expansion is possibly required when a financial specialist doesn't have the foggiest idea of what they are doing. Not many entrepreneurs are agreeable and experienced enough to work in various organisations simultaneously. So, as well, a financial specialist should act like a proprietor and purchase shares just in organisations that are completely comprehended. Warren Buffett is notable for offering his riches to other people and not hushing up about everything. He has even expressed that when he bites the dust, the vast majority of his fortune will go to admirable missions. Although the vast majority of us need more cash lying around to simply toss around to a good cause, we can follow some guidelines from Buffett's experience and return in different manners. There are approaches hold-worthy around a tight spending plan. Regardless of whether you give hair or dress, discovering approaches to do positive attitude causes you to feel great and also give you a new point of view on life. Number 5. Do not place small amounts in each basket. Only buy if you are prepared to put at least 10% of your net worth into the stock. An investor should just purchase partakes in an organisation which he would buy inside and out if he had adequate capital. From this viewpoint, an investor should search for an organisation with business tasks that are comprehended, has great long-haul possibilities, is worked by fair and skilled individuals, and is accessible at an appealing cost. Live beneath your methods, donate quickly, don't upset your money on extravagant stuff, and don't enthusiastically stray keen on the red. Decide the things you appreciate most through everyday life and intend to take advantage of those things. Adhering to these principles, as Buffett does, could prompt a less complex, increasingly agreeable life over the long haul. For example, Buffett still lives in a truly little house in Omaha, Nebraska, despite his millions. He's thinking about remaining there. The home is all he needs. Also, since he needn't waste time with anything more prominent or better, he doesn't require, present, to buy another house. Number 6. Do not sell unless the business fundamentally changes. Buffett never pays a lot for holdings if conceivable. By patience and hanging tight for deals available, he may locate an extraordinary organisation that can be bought on freedom. Similar chief ought to be applied to everything else. These days, they're truly minor motivation to compensate wholesale for items like attire and foodstuff. In a bit of persistence and deal chasing, it is anything but difficult to track down deals, coupons and so forth to make your shopping more affordable. Number 7. Buy at a price below intrinsic value. As indicated by Buffett, the inherent estimation of a business is a genuine estimation of a firm, not bookkeeping or book esteem. He said to sharpen a natural worth, one needs to take the normal future incomes and rebate them back to their current worth. Such figuring ought to likewise think about assessment and edge of security. As per a financial expert, frugal habits seem to be hard to shake off. Buffett, who would probably never go into debt except to borrow the capital to invest for even more profit, sent his daughter round to the Cadillac dealer to favour his new mid-range car in cash. Bryn tells how he still feels bad if he leaves food on his plate at mealtimes. If you are going to go into debt, it should be to borrow investment capital that can produce income and growth. Don't go into debt just to buy a bigger and better widescreen TV. There exists just a couple of valid justifications I can consider to venture into the red. One, for instance, would be to put resources into an advanced degree. That degree should take care of you a few times over later on, so it's very worth putting resources into. What's more, as indicated by Buffett, the most significant venture you can make is in yourself. While you are here, go ahead and click one of these 2 videos on your screen. See you there.